Welcome to THINKpod. My name is Francisco.
And I'm Aziz, and at ThinkPod, we speak about the smartest ideas and the biggest challenges facing the world right now. We speak about where we are, how we got here, and where we're going.
Today's guest on ThinkPod is banking legend Bob Diamond, the former CEO of Barclays and founder and CEO of Atlas Merchant Capital. We learn about his transition from heading a major legacy bank to being a legacy bank disruptor. We look at what he sees the future for the banking sector and why he believes blockchain technology and digital currency are here to stay. Back in your days of running Barclays, you were at the pinnacle of traditional legacy banks, but now you're coming at the very same banks. You're a disruptor. How did you find that transition and what made you make that change?
I think there's two really profound forces at work. The first is the impact of regulation and capital on legacy banks since the financial crisis. And as we all know, it's been, the aim of the regulators were to make banks safe, sound. They focused more on that than making them efficient. It was really about safety. So it was buffer upon buffer upon buffer of capital. And that's not new today. It didn't accelerate during COVID. It's been there, but it's having a huge impact. The second force is the impact of both specialist operators and, in particular, specialists with a technology edge in terms of finding the most profitable parts of the banks and taking that out. I think for years we've seen that happen on the consumer or retail side with Stripe, with PayPal, with Venmo, Apple. Starbucks even takes a lot away. So I think what's happening now, and the reason that we announced our merger with Circle, is it's now an opportunity to really attack what I think is the soft underbelly of the legacy banks, which is more the commercial banking side. Payments, large commercial payments, treasury and transaction services. And if you can imagine a world where with the internet we can make payments instantaneously 24/7 versus call your bank and wait till Wednesday at 2 o'clock. With the technology of blockchain, where we now can have security without hiring a bank or a credit card company to stand in the middle. And with a digital currency which has all the safety, soundness, and benefits of the US dollar and stability of the US dollar, it can be really transformative. And I think those two are the big mega forces, kind of profound forces at work creating this. And the end result today is that the legacy banks haven't become smaller. They're actually bigger. They're more concentrated, but I must say they are safe because of the buffer upon buffer of capital. In the US, the top four banks have over 50% of the deposits in the US. I mean, it's incredibly concentrated. They're much closer to governments, and their risks are much more correlated with governments, but they have so much capital that they're safe. The way I think of it is they become utilities. They're managed like utilities, they're hiring like utilities, they're regulated like utilities. Returns are a lot more like utilities, and all of the innovation and agility is coming from outside. It's coming from tech and other specialist operations.
So perhaps maybe you're saying that they're becoming natural monopolies in a way, and then following up on that point, would you perhaps suggest that perhaps it's time to break them up, give them less power instead of making them more powerful, giving them more opportunities to become more powerful? We're talking about legacy banks here.
Well, it's interesting because I think every regulator, certainly use the UK as an example. The UK, speech after speech after speech, challenge your banks, break up the big four, challenge your banks, blah, blah, blah. They're doing just the opposite. The big four are more concentrated. The risk of the big four banks is more correlated with the domestic economy. And the regulatory move to ring fence anyone with over 25 billion in deposits has to ring fence all their other activities. And this is the part that goes unnoticed. Every single P of deposits has to be invested in a domestic asset. So what happens is all of a sudden HSBC, which has had a very diversified portfolio against its deposits, has to dump those and buy UK mortgages. And the spread between mortgages and deposits goes like that. At the same time, rates are going down. So the challenger bank of Metro can no longer earn a spread to cover their costs. And what's happened is by and large, the challengers have failed unless they have a really serious technology edge. If they've had a technology edge, they're kind of succeeding. But the irony of this is that the UK government that desperately wanted to exit businesses like investment banking and make the core retail businesses safer, I would tell you today it's kind of all chips on black, which is if there's a blip in the mortgage market or the domestic economy, just when the government needs those banks to be lending, they're going to be pulling in their horns. So I wouldn't say breaking up. I kind of don't like that phrase, and it sounds aggressive, but there were 4 key banks in the UK, very concentrated. The attempt was to break that concentration down. The result is they're more concentrated and more correlated than ever. In the US, the big 4 banks are larger, more concentrated, and more correlated than ever.
In the past, you have made the surprising request for regulation. That's quite unusual for a disruptor. Can you explain what your thought process was there?
Yeah, you're referring to Circle.
Yes.
Yes,
Yeah.
where we're embracing regulation.
Yeah.
We're applying to become a bank. So I have to back up and start. Unless you're really, really into crypto, to most people, that one word covers this whole range of stuff, right? You got Bitcoin, you have stable coins, and then within stable coins, you have Tether and you have Circle. So pulling this apart a little bit, I think, Bitcoin is very, very different than what we're doing. Bitcoin is a place for people who want to store wealth away from the government. So they don't want to be regulated. They want to be offshore. It's a little bit like gold. Gold was a place where people were nervous about their government, they would put that, or nervous about war, nervous about the world. But it also provides an opportunity for people that want to hide their money for whatever reason, but usually it's not good if you're trying to hide it. But that's a whole different world. And when people say crypto, they think Bitcoin, I think. Stablecoin, in a perfect world, stablecoin is just a digital version, technology applied to the US dollar, all the benefits of a US dollar, but it's digital. But even within that, there's Circle on one side which says, please regulate us, we'd like to become a bank. We're not really credible as a payment mechanism unless everyone believes that we have the full faith and credit of a dollar behind every stablecoin. So we've also announced that we've only got cash and short-term US Treasuries standing behind. Ultimately, we'd like to become a full reserve bank, and at that point we can hold our stablecoin in Fed deposits. So we want to be more regulated, more conservative, and on the other hand you have Tether, which is larger than we are, although we've been gaining. Like I will say, we've been gaining like crazy. But they're a bit murky. They're offshore Chinese, have no interest in being regulated, have kind of a dodgy portfolio of assets behind. And I think the regulators in the US, the Fed in particular, who both Jeremy and I have spent a lot of time with, their biggest fear is that the cash backing each US digital coin would not be there in times of a crisis. And they hark back to 2008 and what would happen if we had to bail out a stablecoin. And we understand that. We actually agree with it. So it's time to be regulated. And the frustration is we are highly regulated, just as PayPal and Venmo and everyone else is, but it's state by state. And we actually need the federal level. And so if you're a casual observer and reading the media, you would think that we're running around trying to not be regulated, and the regulators are going, you bad boys. And actually we're saying, no, would you please do something? Regulate us. And then the last point I'd make is there's a lot of talk about if there's going to be a digital dollar, it'll be created by the central bank. Why do we today want to become China? China's creating a government-owned, so we're going to trust that? The Fed wire was not created by the Federal Reserve Bank. It was created by private actors, and then it's regulated. So are you going to get more agility and more innovation with people like Circle and many, many others developing the protocols and developing the innovation in the digital currency and then highly regulated by the Fed? Or do you really want the Fed, who has no track record of innovation or agility? That's not what they're trained to do. It's not what they have done, to be developing the digital currency. So we can live in either world. We can live alongside a central bank digital currency, but we would really encourage the Fed to think about allowing the private actors to develop, but have it highly regulated.
So when you left Barclays, you've had to face a lot of challenges whilst managing Barclays. Obviously now seeing COVID, what would you have done differently if you were in management during the pandemic?
It's a good question. I think turning that question on its head a little bit. I learned to answer the question I want to answer rather than the one that's asked. Learned that very early.
It's an art.
But the question was, do I miss being the CEO of Barclays? And my answer is, I miss terribly being the CEO of Barclays prior to 2008. I don't miss at all the part that was post-2008 when it was a transition to regulation, utility. And I don't mean that necessarily as a value judgment, but when I joined Barclays in 1996, we didn't have an asset management business. We didn't have we had an investment bank that had never earned its cost of equity. We built from scratch Barclays Capital, which is probably the only from scratch bulge bracket bank, ultimately acquiring Lehman Brothers for less than the price of a building. For 12 straight years, every single quarter was a 20% compound increase in revenue and profits. We expanded globally. We're highly successful. We drove the share price of Barclays. Very innovative. We were allowed to build businesses. In the asset management business, we acquired Barclays Global Investors from Wells Fargo Nico in 1996 for £500 million. Without doing any acquisitions, we grew that business from $500 billion in assets under management and $50 million in earnings to having $3 trillion in assets under management and $1.5 billion in annual earnings. And we merged it with BlackRock in the worst of 2009, March 2009, for over $15 billion. A business we bought for $500 million and built it all organically. I posit, could anyone do that in a bank today? Would they be allowed to take that kind of an innovative, agile process? So that's my answer. Is I think it's a different job today than it was. It's got a lot of governance. It's akin to running a utility. Now within that, there's great banks and not great banks. And so that can disguise it when you see the performance of JP Morgan. But I would also add, you'd have to peel away from JP Morgan, as outstanding as their results are and how well managed they are. In the third quarter, they had $11.9 billion in revenue. If you take away the $2.1 billion, which was a write-back of provisions, so you're just over 9. 3.3 of that was just advisory fees in the investment bank without sales and trading. So if you strip away the investment banking business and the asset management business, it's nowhere near the kinds of returns we're seeing, which again, even the legacy bank within JP Morgan or Bank of America, with higher costs, technology challenges, the attack from Stripe and Venmo and hopefully Circle, the future of that legacy bank platform is probably low to high single-digit returns at best. One of the interesting things of the crisis as well, though, is the Europeans, the Swiss, and the UK pretty much handed the investment banking business to the US. If you look at those numbers in the third quarter, they're just stunning. I mean, Goldman Sachs had $3.7 billion in advisory fees in the investment bank in one quarter. I mean, it's numbers that are unimaginable. Where's Barclays? Where is Deutsche Bank? Where's Credit Suisse and UBS? And that attitude of the regulators in the UK and Europe to kind of punish the banks that had any business away from deposits and lending, I think it's being seen now as probably an overreaction.
Right, so you talked about innovation and how that enables you to organically build value over time. What do you think were the most conducive factors, both internally within management and externally within the environment, that enabled you to go through that you don't see today in the market?
The opportunity to build businesses from scratch, to have that, constant investment day after day, to acquire talent. These things take quarter after quarter after quarter after quarter. And if I look back at the building of BGI or the building of Barclays Capital, was pretty consistent quarter after quarter after quarter, and it wasn't stop and start. And I just don't think the environment right now is conducive from a regulatory point of view of allowing that kind of an investment. And to use risk with a small r, that kind of risk, because not risk necessarily from taking a bad position in the market, but the risk of growth, because if you hit a bad quarter, you're going to have a negative return.
Do you feel like legacy banks' hands are being forced and it's not voluntary movement that they're doing right now? Do you think if there was no disruption coming from outside, it would have taken a lot longer for legacy banks to kind of move from their rigid structures and adopt the technology at the pace that they're trying to adopt at this point?
Of course, competition is always a good thing, right? So, I mean, that's not just in legacy banks, that's kind of in life. If you're not getting competition from somewhere and you're kind of, if not an oligopoly, you know, a fairly secure, regulated environment, there's not going to be much motivation for change. So I would say for sure. That's why I think a lot of what seems to be stressful in the crypto world is actually really positive in terms of the financial services industry. And certainly a lot of what we've seen on this retail and consumer side has been just that.
When you look into the future of investments and the asset classes that would thrive perhaps, you know, from your years of experience, where do you see the money really moving towards?
We focus just on financial services, so we're very biased. I can answer that within financial services, but I'm sure healthcare has a lot of upside, but it's not our area of focus. And it's no question that there is some great value in some of the legacy platforms if you could become an investor and really drive change actively. But to be honest, that's not where investors want to put their money. Rightly or wrongly right now, it's a lot easier to get investors excited if there's a technology edge, and you can see why. And I think that has accelerated during COVID significantly.
One area that gets a lot of attention from investors in this past period, especially with climate change and COVID pandemic, is ESG-based investments. Where do you stand on that debate?
Listen, I stand squarely behind it. And I think ESG is not as scientific an application today as I think we would like it to be.
Yeah.
I love to challenge people sometimes and ask them what the G is, and they stumble for a second, and then when they figure out its governance, I say, does that mean like regulation, or does that mean the board, or what does it mean diversity? What does it mean? So I think there's a lot of unknowns, but the concept, which is responsible investing, is here to stay. And I think we have to use that kind of a lens in everything we do. So I mean, I'm making this up a little because I'm not familiar, but I know a lot of the debate around the amount of energy that's required in creating bitcoins, for example. I think that's a healthy debate, and they should have an ESG prism as well. So I don't think because you're technology, you escape the importance of ESG. And the crux of the whole thing, frankly, is if it's important to our investors, it better be important to us. And I think it's becoming increasingly important.
So I have one question to wrap up. You have an impressive career. I'd say this role is perhaps your most exciting today. What is the personal legacy you'd want to leave to your grandchildren?
Always work your hardest.
Concise.
That's the
Wise
point.
words. Yeah.
Well, Mr. Diamond, thank you so much for your time. It's a delight to have you at the podcast, and it's lovely to network with you. Thank you so much for your time.
Great, thank you. I'm glad I found you guys.
Thank you both. Thank you.
We would love you to let others know about this podcast.
So please rate us, leave us a comment, and share with someone who might enjoy it too.
And don't forget to hit the subscribe button so you don't miss out on our next episode.